Hey y'all, welcome back to part 2 of the Mindset, Market, and Money series. If you're new here, my name is Amina, also known as the Neurodivergent Investor. And in this series, we're going to take everything we learned about the mindset and start applying it to the markets. Now, if you missed series 1, make sure you go back and watch those videos, because in this module, we're getting into the fundamentals of options trading. But don't worry, I'm going to keep it simple, clear, and beginner friendly. By the end of this series, you'll understand what options are and how they work, the difference between calls and puts, how to read an options chain, and how to use the Greeks to measure risk and reward. We'll also talk about how to choose the right strike price and expiration based on your trading goals. This isn't about just learning terms and definitions, although that is very important because you do have to learn the language, but you'll also learn how to think like an options trader, how to look at the market through the lens of probability, time, and volatility. This series is designed to help you build your confidence and give you a real edge in the market. So if you've ever felt overwhelmed by options or just not sure where to start, you're in the right place. Let's break it down, build your foundation, and help you start making smarter trades. Now, if the word options make you think of complicated math, Wall Street suits, or secret formulas, don't worry, I've got you. This lesson is all about breaking it down so anyone can understand what options are, how they work, and why so many traders love using them. Whether you're here because you want to learn how to make extra income, protect your investments, or just level up your trading strategy, options give you more power and flexibility than regular stocks alone. At its core, an option is a contract. It gives you a choice, a financial option to either buy something with a call option or sell something with a put option at a specific price before a specific date. Think of it like this. You walk into a store, you see a jacket that you love, and it costs $100. You paid the clerk or the store owner $5 to hold that price for a week. If within that week the price goes up to $150, you still get it for $100. But if it drops to $60, you can walk away. You're not locked in. That's basically how options work. Now let's break down the two most basic types of options. You have your call option, which equals the right to buy. That means you believe the price will go up. You lock in the price now so you can buy it later if the price rises. For example, if you purchase an Apple stock that's trading at 175, not an Apple stock. If you purchase an Apple contract that is trading at $175, you'll buy a call option with a $180 strike price. Now, if Apple jumps to 200, you can buy it at 180 or sell it at 200 and keep the profit. On the flip side, you have your put options, which is equal to your right to sell. You believe, if you're invested in a put, you believe the price will go down. So you lock in a price now so you can sell it later if the price drops. Here's an example. You buy a put option on Apple with a $180 strike price. If Apple falls to $150, you can still sell it at $180, and that's how you get your profit. Now, let's get into the nuts and bolts. Here's what you're really buying when you buy an option. One options contract equals control over 100 shares of a stock. So if a premium is $1.50, you're actually paying $150 because it's $1.50 times 100, and that's your option size. Then you have the options chain. This is where all the available options are listed like a menu of different strike prices and expiration dates for each stock. Grab your pen and paper because here are some key terms you should know. The underlying asset. That's the stock, like Apple or Tesla. Strike price is the price you lock in. Expiration date is when the contract ends. Your premium is the price you pay to buy the option, and your multiplier, usually 100, because each contract covers 100 shares. Now let's talk about how options are priced. There are two main parts. The intrinsic value. This is the built-in value if the option were exercised right now. For calls, it's the stock price minus the strike price. And for puts, it's the strike price minus the stock price. If the math is negative, the intrinsic value is equal to zero. Then you have extrinsic value, which is equal to the time value. This is the maybe money. It reflects the potential for the stock to move before the option expires. And it's influenced by time until expiration, volatility, interest rates, and a popular pricing formula used by pros called the Black-Scholes model. Just know that more time and more volatility equals more value. Now remember, options don't last forever. They have an expiration date. After that, the option either gets exercised or expires worthless. Types of expiration are weekly options that expire every Friday, monthly options that expire every third Friday of each month, and then leaps that can last 1 to 3 years, which is great for long-term strategies and one of the strategies that I personally use. As expiration gets closer, time value decreases, and this is called time decay. So let's recap. Here's what we covered in this video. An option gives you the right, but not the obligation to buy, just called a call, or sell, just called a put. Each contract covers 100 shares. The price you pay is the premium, and options lose value over time, so you have to watch that expiration date. Options are priced based on intrinsic value and time value. Now, in the next lesson, we're going to explore something called the Greeks. They sound fancy, but they're just tools that help you understand how your option reacts to changes in price, time, and volatility. To help you go over what we talked about in the video, click the link in the description box for the homework assignment that will help you start thinking more like an options trader, and it'll help you review a lot of the terms that we discussed in this module today. Don't forget to like, comment, and subscribe, and I'll see you in the next video.